Okay, hallo, guten Abend. Mein Name ist Mathis. Ich bin hier mit Matt Klein. Dieses Event ist auf Englisch, deswegen werde ich auch gleich auf Englisch weitersprechen. Und ich hoffe, dass das so auch funktioniert. So, all right. Good evening, everyone. Thanks for joining us. We have Matt Klein here with us today. Matt, thanks for joining us. And we have a discussion on Matt's and Michael Pettis' book, Trade Wars or Class Wars. And before we get started, there's short housekeeping. We have down below in the description, there is a link to sli.do. It's a tool where you can post questions that you have for the discussion we have. Matt and I will have about like a 30-minute discussion, and then we'll switch over to taking questions from the audience. So please feel free to post questions there. And if you want to also check whether maybe your question has been posted before, so you can upvote other people's questions and you don't have to post your own. All right, without further ado, I'd like to introduce Matt Klein, who studied history at Yale and then spent some time in doing research also in the finance industry, and then started a very impressive career in journalism, working for The Economist, Bloomberg, the Financial Times, and is now the economies commentator at Barron. Together with Professor of Finance Michael Pettis, who's in Beijing, he is the author of Trade Wars or Class Wars, which came out in May of 2020 in Yale University Press, and received considerable media attention, I would say. So we're happy to have you as a guest for discussion.
Thank you very much.
So the book offers an account of like current global economic power relations through, I think, a combination of two lenses that aren't seen very often together, namely a class analysis and the savings identity. And so you start dissecting from using the savings identity in that we know from economics, a lot of the inequalities and trade interdependencies globally. And we'll try to talk about this analysis. But before we get started, maybe you could take us on a quick journey on what's the savings identity and why is it such a powerful tool to dissect economics.
Absolutely. So the thesis of the book is that trade wars are class wars because what occurs in one part of the world ends up affecting people in the rest of the world, because essentially we're all a connected global system through trade and through finance. And so when we talk about the savings identity, there are a couple of ways of it somewhere else. Another way of putting it is that it's impossible for everyone in the world to accumulate financial assets at the same time, that if someone is buying, someone else has to be selling. These things all fit together. You have, for creditors are only possible to be creditors if they're also debtors somewhere else. Trade surpluses are matched by trade deficits. These are all different ways of saying the same thing. The point that we sort of add here, which is not, shouldn't be that controversial, and in fact it's backed up by a lot of empirical survey data, is that there happen to be certain entities in the global economy that systematically have different kinds of saving and spending behavior from others. So most people, if you give them money, they'll spend basically all of it. Maybe not immediately, but certainly over the course of their lives. That the saving rate of households and sort of the bottom 90% of the income distribution is more or less sort of like 0 to 5%, and this is true all over the world. The entities that are different are really two. One is corporations, and the other are the very, very rich households. And there you have very different kind of behaviors where savings rates can be much higher. So rich households, the savings rate is sort of like 40 to 50%. And, that can increase even higher, if you go even more, minute parts of the income distribution. And then companies will save a great deal, and their savings show up as profits. It's sort of just, again, like an economic definition. If you see somewhere someone talks about the corporate saving rate, that's just a way of talking about profitability, essentially. And what this means is that if you have a shift in the distribution of income such that more income or purchasing power is going to those kinds of entities, whether it's the very rich or the companies that effectively they control, because rich people generally own corporate equity that makes those decisions, then that is going to, all else equal, affect the overall mix between saving and spending in a society. Now, the wrinkle here, which is important, is that if you're saving more, then that means someone else is, dissaving more.
Mm-hmm.
And so globally, what we've seen is that on the one hand, we have this shift in the distribution of income and concentration of income, and we've also seen a very large increase in household and government indebtedness.
Mm-hmm.
And our view is basically that these things are sort of have to be connected, that the only way it's possible for the income of the super rich and companies to have increased the way it did is because they didn't lose out on revenues. And the way they didn't lose out on revenues is that they were able to keep selling things to people who weren't having their own commensurate increases in income, and the difference was made up through debt. And the trade angle here is really just that, the increases in the inequality, the increases in the debt, the changes in spending don't all happen in the same place. And there's no reason why they would have to happen all in the same place. And so to the extent that you have differences in one way or the other, that shows up as trade imbalances. So for example, you can look at a country such as Germany, where you have a pretty sharp increase in, particularly between really sort of the mid 90s and about 2007, a very sharp increase in the share of income going to businesses and at the expense of essentially workers and consumers. That doesn't lead to rising debt in Germany at all. It effectively coincides with rising debt in the rest of the world, particularly Germany's European neighbors. Then you can also look at places such as the US, where it's sort of not quite the reverse. The US is a more complicated case, but essentially where you have a lot of rising debt that doesn't really go along with rising consumption, because it's offset by lower production. So there's a lot of other things going on, but that's basically like the essential story of how inequality and saving identities and trade link together.
Yeah, and we'll dig into that as we go through. So I'll try to I read the book, and I'm trying to place some goalposts here before we take questions from the audience, and we'll definitely focus on the German case more thoroughly. I was thinking, so we started this online series essentially in, I think, March 23rd was the first one, where we talked about what is the German treasury doing at the moment. So I wanted to put this back to you. What went through your mind week of March 15 of this year? If you take this whole, you must have just had, you just have finished writing the book, and you say at some point, okay, trade flows are determined by financial flows, and then in March 15, all of these financial flows collapse. What were you thinking? What happened?
That was a pretty, momentous period of time. And actually, we're being very specific. On March 15th, I was just about to come back from parental leave, but so I was trying to savor the last week or so of not thinking about this. But one thing that you can see very clearly in that is the extent to which the Federal Reserve, in particular, for the rest of the world, I think was explicitly done to prevent the kind of collapse in trade that you're talking about. That because you had these, essentially freezing up of markets, that that's essentially what central banks are supposed to do, is sort of prevent, if you have these kinds of exogenous crises, is to prevent them from leading to hits to the real economy. And I think that kind of worked. In terms of like the German treasury aspect of it, I don't know if this is where you were going with it, but I think it is really interesting and encouraging that there was a real shift in terms of the stereotypical German government position for really the past 20 years would be, well, we can't afford it, so we're not going to spend any money to do anything about it, and deal with it. And that's not what happened this time. Not really. And that, there are different ways of counting these things, but at least sort of a headline measure is that the fiscal response budgeted by the German government was actually, was it like 10 percentage points of GDP? I think it was something, it depends, I guess, where you how you count it and stuff, but it was quite large, and basically like among the largest in the world. It wasn't necessarily quite as big as what happened in the US, but it was very, very large. And moreover, you also had the German government coming out saying that, the EU should issue debt on behalf of, everyone in the EU, and then use that money to provide direct relief on the order. And again, we can talk about whether the amounts are big enough. I would suspect not, given the scale of the crisis, but still, that's a significant shift. And so those are the kinds of things that actually, I think are quite encouraging. I don't know, you probably have a better sense than I do of what it really means in terms of a shift in German, political opinion or elite consensus. But as an outside observer, It's very encouraging.
We'll definitely get to that in a little while. I wanted to stay a little bit further outside of Germany for a second.
Fair enough.
So in your book, there's a lot on tax evasion, and then you make these 3 case studies essentially on China, Germany, and the US. And there's a story essentially where you say, well, ordinary people in China lose their health and wealth to elites. And in the US, ordinary people have to take on debt to sustain their ordinary life. And I wanted to ask you maybe if you could just, for those people who haven't read the book, kind of walk us through the steps, how those transactions work.
So one of the big overarching arguments of our book is that global prosperity is not a scarce resource that needs to be fought over. And at the same time, when we think about trade conflict, it's really, I don't think, very helpful to look at it as, some country wins at the expense of another country. That really, this is why we talk about, the class wars element, that really it's most people everywhere are losing out for the benefit of relatively few people who are dispersed globally. And so you can see that very clearly in the US-China relationship, I think, because if you look at, the policies the Chinese government has historically pursued, they were done for the benefit, it was part of an overall development strategy, but it was also done for the benefit of essentially the Communist Party elites and in cooperation with business elites from other countries. So American multinationals and the owners of American multinationals were some of the biggest beneficiaries of Chinese government policies that included things such as the suppression of Chinese workers' rights, the frequent, essentially, appropriation of land of regular Chinese people, the lax environmental regulation that led to lots of pollution, the under provision of social services. The beneficiaries of that included rich Americans. So it's not as if China was taking advantage of America as a whole. It was that rich Chinese and rich Americans were taking advantage of most other Chinese and most other Americans who were losing out from this exchange. And that's really what we wanted to convey.
So there's a question that came up to me when reading this. So the literature I try to follow as closely as possible is the BIS's literature on the international monetary system or financial system. And I think this is sort of established by now that they say that in 2015, this paper at Vitiev of saying, so this triple coincidence of the nation state and the currency area and the decision making about a currency, this breaks down, right? So we have global offshore money creation, and these units don't overlap anymore. And taking this analysis, I thought about, there's this paper that came out, or this blog post by Dominic Leuser and Jakob Fengen in I think March or May, where they say, so there's this class system, class dollar system, I forget. And I feel like they take this analysis of the triple coincidence breaking down to a different point, where they say if it breaks down, then we have international classes. However, your analysis, I feel like it's very nation state bound, because it uses the balances of payment, which is a national analysis. So what do you think about that?
I'm not sure there's a conflict. I mean, I agree that I think a global class, I mean, that's sort of like the argument of the book, right? We were inspired to write this. So this came, Michael and I were talking about this basically the end of 2017. And this is really when, President Trump was sort of starting up the argument about trade conflict that really just continued to build over the subsequent couple of years. And it was really from the framing of, this country is taking advantage of this country, or, we're going to get a better deal. And our view is that's not really the right way of looking at it. And that's sort of what we were just, what I was just saying about, it's much more useful if you want to understand what's going on in the US-China relationship to look at these class issues. Now, that doesn't mean the balance of payments isn't useful. I mean, the balance of payments, it has a tremendous amount of interesting information, and you just have to know how to interpret what it means. So, for example, one of the reasons we talk about corporate tax evasion in the beginning of the book is that, a lot of things that occur in the balance of payments, particularly in certain smaller countries like Ireland, just don't make any sense unless you understand what's going on with corporate tax maneuvering. And for that matter, even in the US, like, why is it that the US has such a large income surplus on the current account when the net international investment position is so deeply negative. I mean, that seems like a weird, I mean, you could say there are higher returns on assets, but if you actually look on the asset by asset class, there's really only one asset class where that's true, and that's FDI. And if you break it down further, you can see that it's FDI in basically 7 jurisdictions that are known to be corporate tax havens. So it's Ireland, the Netherlands, Luxembourg, Bermuda, Caymans, Switzerland, and Singapore. That, which I believe that's 7, and that's that's essentially the entire difference, right? It's like I think it's something like 80+% of like the U.S. total income surplus in the current account comes from that, and everything else just wash or negative. So I mean, like you have to, it's very useful, I think, to have this kind of perspective. And I think when again talking about before in the beginning, like the balance of payments are helpful for understanding, if debt's rising in one place and not another place, but there's a sort of global phenomenon of this imbalance of production and consumption and inequality and what that is affecting, then the balance of payments is useful for showing where it's going to show up. Yeah. So I to your point, I don't think there's really any inconsistency there between that approach and our approach.
I very much like this example that you made where you said the debt created by the U.S. Treasury in a certain period of time kind of matches the profits that U.S. companies registered in offshore regions, especially Ireland, I think, which is weird to think, right, that Europeans pay Apple money and then Apple buys U.S. treasuries with it, and that's essentially what happens.
Right. I mean, it's also, I mean, there are other people who can speak more precisely to the details of, Apple's tax arrangements, but I mean, it's not just Apple Ireland selling to Europe. I think they basically sell to everyone, or many other entities. And then but you can see, I mean, that's like the point. I mean, you're talking about that. It's if you look at the reinvested profits, of, in these corporate tax havens over, I think it was like 2012, 2017, where basically right before the tax law change and some of that started getting paid out in dividends, that basically perfectly matched the holdings of U.S. fixed income in those countries by supposedly the residents of those countries. So this is a good example, like, who's a resident versus who's a national, like that's a big difference, right? Yeah. Microsoft's Singapore office might hold a lot of U.S. treasuries, but it's not Singaporeans, right? But anyhow, so, that redounds to U.S. shareholders. And that's, this is the kind of, it's very helpful to understand how all these pieces fit together.
Yeah. That brings us back to the U.S. So you say at some point that the French just had it totally wrong to say that the U.S. has an exorbitant privilege that they can borrow cheaply. And then you say, well, that's actually an exorbitant burden. And it's a burden for working classes, as I understand. Then it leads me to the question, is it only a burden to the working classes, or does this, have repercussions to the U.S. corporate sector as well?
What's interesting is I think is that the global demand for holding dollar-denominated assets and saving money in the U.S. makes the dollar much more expensive than it otherwise would be. And that means that if you are in the business of making things that either compete with foreign imports or that you're, competing in third markets as an exporter, you're going to be at a severe disadvantage. And so that can affect the corporate sector insofar as you're not going to want to be producing things in the U.S. to export to the rest of the world or make things in the U.S. to sell to Americans. Not necessarily bad from a profit perspective, because you can just relocate your entire production, to somewhere else, which is often what they did. So the impact there, it doesn't seem to have hurt the corporate sector insofar as if you look at sort of aggregate U.S. profits and profitability, or stock prices for that matter. But it's clearly bad for people who are actually working and doing those jobs. And it's bad for smaller businesses that might be supplying them and can't really relocate that way.
So that's the small businesses the Fed tries to get into their programs now as well.
Yeah, I mean, it's just in general, like smaller businesses, there are a lot of reasons why that program is having challenges. But it's essentially, if you don't, the Fed works in capital markets and it works with banks, but it doesn't work directly with others. So, buying bonds, if you're a company that issues bonds, the Fed can help you. And if if you're a bank, the Fed can help you, but if otherwise it's much harder. I mean, they can try to come up with mechanisms, but the small businesses, they get bank loans, or they have internal finance, but otherwise that's not. So that's like a big challenge. And I mean, you've seen that in Europe too, I think, where it's much more bank finance based, and so you've had a sort of struggle of how do you pass that through, and the ECB's been sort of innovative in trying to get around that. But, I don't know how well it's really worked, but yeah, it's a.
So speaking of this of Europe and the global dimension, there's this this argument that you make at some point to say, after the European debt crisis, essentially Europe didn't rebalance globally. It essentially just put austerity programs onto a lot of peripheral countries, which turned into surplus countries. The EU is a huge surplus bloc now. And essentially what happened was that the rest of the world had to absorb this surplus, right? So, and then you say this is emerging market economies, the US and the UK. And what I'm wondering then is, what's this connection between the Euro crisis and the debt fueling that we saw, or the debt buildup that we saw in the recent years? Are emerging market economies, were they fragile because of the European decisions that were taken?
I think that's fair. So again, sort of like zooming out, like the general problem, which is sort of manifest in different ways, is that globally we have, as a species, we have the tremendous ability to produce a lot of things. And for various reasons, we haven't really been consuming enough and investing enough to sort of match that productive capacity. And that's created this perpetual sort of imbalance where, if there isn't enough demand, then that means that you're going to have a much harder time, boosting your sales. You're going to be fighting, companies are going to be really, instead of just enjoying sort of overall sales growth, they're going to be fighting much more for market share. And, and also again, like if the reason that demand is suppressed is because you don't have enough income growth, but, and so the extent that you have rising demand, it's fueled by primarily debt, governments and household debt, then again, like that's sort of an unstable phenomenon as well. And essentially what you can look at, so that's from that sort of global picture, what happened with Europe essentially is that before 2008, Europe as a whole was producing and consuming about, roughly equal amounts. That's why Europe essentially had a balanced trade. But within Europe, you had these severe imbalances where, on one hand, you have a place like Spain, which was, on the one hand, actually exports growth in Spain was fine before the crisis. It wasn't like, the loss of competitiveness narrative is not really right. But domestic demand was just growing extremely rapidly. And maybe that was justified, maybe it wasn't. You can argue that a long time. But regardless, the adjustment that occurred after 2008 was purely on the lower domestic demand side. And that's what you saw in many other parts of Europe. And so the result was that while overall the European economy shrunk and then grew slowly, the domestic spending fell much more and grew much less. And so you basically, even as of 2018, 2019, before the coronavirus, but things were going ostensibly relatively well, domestic, and that's where the adjustment came from. It wasn't like they suddenly, Portugal did like do a good job getting a lot more tourist revenue. So that's like an example. But in general, if you see these adjustments of like, how did Italy have a current account adjustment or Spain have a current account adjustment? It was predominantly through just lower domestic spending and lower living standards. And that wasn't matched by higher domestic spending and higher living standards elsewhere in Europe, which means that they're producing more that's not getting, someone else has to absorb it. And, they're not absorbing it by being able to sell things in exchange. So like you look at, say, Turkey, right? EU is a big trade partner with Turkey. If Turkish companies aren't able to sell more stuff to Europeans because European total demand is lower, then that means that either they just have to make less stuff or they have to rely more on their own domestic demand to absorb it. And, if they do that, then that's going to be associated with debt increases, which in fact is what happened in Turkey. And, that's essentially the thing, right? If you're making things, you can sell them at home, you sell them abroad. And if suddenly your abroad market just tanks, then, that creates problems for everyone. And that's, I think, in a nutshell, the sort of the European problem.
So, if I think back at my economics macro 1 course, then there would be some rebalancing over the long term. Why is it not happening, though?
That is a big question. Like you'd expect these things to have changed. And the fact they've been so persistent, I think, is why, you need to have some sort of political economy explanation, because, normally you don't have these things happening. I mean, the standard narratives you have is that persistent trade imbalances are not possible unless it's due to persistent, real growth differences. And, oh, well, if so for example, like South Korea basically had trade and current account deficits for almost 50 years after independence. And that was, there's a good reason for that, which is that it was a country that was initially extremely poor after the Korean War. And then it progressively industrialized and became basically, similar living standards as, France. And so that required a lot of investment. A lot of that came domestically, but a lot of it came imports, and that's fine. But, for other countries and other societies, it doesn't make sense to have those kinds of persistent imbalance unless there's something wrong. So, the question, in China, for example, we can point to a lot of specific things the government has done for essentially its own domestic reasons, but that have suppressed household spending, and that, tends to lead to these sort of persistent surpluses. Or you can look at, again, like we can talk about in Germany, various choices, which again, I think were mostly done for domestic reasons, but because of the interconnected nature of the global system, that those domestic choices ended up having international effects that were surprisingly persistent. And so why you don't have rebalancing is, that's partly why I wrote the book, is like, there's a lot of specific things you have to look at, and that will, explain some of it.
Yeah. So maybe we should talk about the German case a little bit. What I found interesting from, there's a lot of discussion about the debt brake in Germany right now because it's suspended. And I feel like most of the time people situate the debt brake, that it starts as this thing after the financial crisis because banks had to be bailed out. There had to be, this debt had to be reined in. You start this story essentially at in the 90s, so saying there's reunification, there's a lot of debts because of the valuation against the Eastern German mark. And I was wondering, why did you pick that point in time? Because I feel like you could have picked the 70s, where there was, the Bundesbank already was very conservative on fiscal policy. So what made that event so specific, or so special?
That's a good question. I mean, I think, one could have written a much longer and detailed book on like the history of German economic policymaking and stuff, and that's not what we wanted to do. I mean, part of the reason why we started it, that narrative when we did, is, first of all, it was just really compelling to me in particular that like 1989 was so significant for both Europe and for China, obviously for very different reasons, but still like very significant. And that moreover, you can trace a lot of specific, policy choices and political economy developments from the reaction to what occurred in 1989. So that was like a big part of it, to be honest. In terms of the debt story, though, I mean, like a lot of the narrative, I mean, again, like you probably know more of this than I do, but like a lot of the narrative that I found in terms of the political conversation about the need to really change German welfare state and stuff seems to me like start in the 90s, like, the Roman Herzog streak talking about these things. Like, it seems like this is really like that's like the beginning of it. And then like you really start seeing actual shifts occurring basically in the late 90s and early 2000s to actually kind of put that into practice. I mean, you can also tie it for that matter into like Maastricht Treaty things, which obviously have antecedents that, precede 1992, but like it starts in 92 and it arguably is part of the reason why, the German austerity measures that it did in the 1990s, which led to the slow growth then and sort of led to things. I mean, it's funny because you're saying we could have started earlier. I mean, our thought was that we started it earlier than a lot of people do, because a lot of people start the story with like Hartz 4. And we were like, no, you actually have to go before Hartz 4. And you're saying, you have to go back to 70. So I mean, you can probably go back to like
you can always go back
or something, yeah. But but
okay, fair. There was actually so there's one thing that I found extremely striking that I didn't know. That the average Germans are richer than the rest of Europe. The median household in Germany is about as wealthy as the median household in Greece or in Poland, which I found very striking. I wasn't aware. And it's interesting, I think, that this discussion doesn't play a role much in European politics, because if this is this, inter-European class that's losing out, you could see that in party politics, but you're not.
Right. No, I agree. That's fascinating. I mean, it's funny. So when those data first came out, I believe in 2013, when the ECB did this big survey, and it did actually play a role, but it played a very unhelpful role, which is basically, a lot of German politicians said, "Oh, see, like we're poor, we shouldn't be bailing out Greece," which is, I wouldn't say is the main takeaway here, but yeah, I mean, I definitely agree that like looking at this and going back to sort of the genesis of this book, Michael, my co-author, wrote a really impressive piece. I guess it was beginning of 2015, and he basically explicitly said like you don't people are talking about European debates of about country versus country. You really should be thinking about class. And like regular Germans have not done well. So why is it like that you have this why is it people think about Greeks versus Germans when it really shouldn't be? And it is some like this big mystery. Like you could have had, I can't say this is the reason, but I think it's sort of interesting that a lot of the sort of center left parties in Europe basically hurt themselves by participating in these things in sort of the pre-crisis period. I mean, the fact that like a lot of the German shift to austerity and the reduction of the welfare state occurred under Schroeder and the Red-Green coalition. I'm an outside observer, so I might be totally wrong here, but like I feel like that definitely distorted and messed up German politics for all the years afterwards, because you can't then have like the SPD come in like opposition to it, or at least it would take a while to make that sort of credible. And can't speak to like what happened necessarily in other European countries, but I mean the fact that for example, Dijsselbloem in the Netherlands is from the Dutch Labour Party. I mean, like, I don't know, like clearly there just isn't like the functioning of the idea of having some kind of transnational European party politics was not really working the way it's supposed to, unfortunately.
I have a question though. So at the end of your book, you make like a couple of like very brief suggestions of how to address these imbalances. And so I think what you say at some point there is, Germany could essentially raise wages. The US could, still absorb a lot of the imbalances, and China could, have larger social spending. And what I found striking about this was that you place a lot of agency on politicians of saying, well, you can make these choices. But the preceding argument feels very much like a structural reading of there's very much these constraints of how international economics works. And I wonder, if these decisions could be made, for example, in Germany in the early 2000s, what could be different now that decisions could actually be taken?
So it's an interesting point you make about the constraints versus the agency, because I mean I think we try to make the point that that's a mix of both, that there are real constraints that you face, and there are real trade-offs. For example, if you are, say, France, you're running a current account deficit, you have a budget deficit, your government, like you can do things like higher domestic debt, and if you have limits on how much domestic debt you think can be absorbed, then that limits your options. And I mean, essentially, you can sort of tell the story of the post-Euro crisis adjustment, which I think we do basically say this is like that's the problem, right? That like the reason why it went the way it did was because the adjustment was purely by countries losing access, having had access to borrowing, and then losing it really dramatically, and then you have to cut your spending, whether it's businesses and households or governments, and that's what you saw basically across the crisis countries in Europe. I think though that there are a lot more options, a lot more flexibility for countries on the other side of things. So the reason why I focus so much on the surplus areas is precisely because they do have a lot more flexibility. There isn't really the trade-off, because if you're already in a situation where you're reducing debt and you're accumulating assets, all you have to do is just do less of that. And so, that leaves you relatively unconstrained. And so, you look at the German, and again, like this was written, we wrote this before the coronavirus, but before the coronavirus, prospective real interest rates in Germany were very negative. This is like a Bundesbank series. They estimate this, and I think it was like -2% or something for 10 years. So the idea that, I mean, you'd have to work really hard to find investments in Germany, public or private, that would not be profitable under those conditions. And, especially when there are a lot of people who have been pointing out what kind of public investments in Germany would be useful, whether it's, high-speed rail or, better energy infrastructure or better broadband. I mean, a lot of things that, people who are in Germany have written a lot about this. I mean, it seems like you're just leaving a lot of money on the table. And so, like, from that perspective, there isn't really a constraint. I mean, there is a lot of agency. Just like the reason we sort of structure the book that we do is sort of historical narrative to point to particular decisions that were made. Like, there were choices, and there could have been different choices, and you can change those choices. I mean, China as well. There were plenty of choices that were made that could have been done differently, and you can still imagine different choices. It might be hard. There might be sort of entrenched interests or sort of the political economy developed around the existing system that makes it tough to change it, but it's possible. And that's really, what we want people to understand, that it's not inevitable, that there is a lot of agency available, and it doesn't have to be this way.
It's interesting also to note that the ECB came out with research yesterday about this next generation EU package of spending, and there's in the last and then they try to say which country gets what from the package, and then in the last paragraph they very slightly have this note saying, well, it would be nice to see more permanent fiscal spending on EU level. And it's interesting, I think, to note that there is a change in thinking probably at the ECB as well, from if we compare now to back then.
Yeah, absolutely. I mean, you look at, Trichet to Draghi to Lagarde, there's definitely been an evolution there, I think. I mean, you could argue, I don't think they did, but you could argue that the whole point of ECB bond buying of every government bond, and for that matter, corporate bonds, is to make it easier to issue more of them. That if there is this sort of stable demand, then it's okay. Now, the problem is it didn't work out that way because, for a variety of reasons. But, that would be a sort of a logical way to respond. It's really strange actually to think about, the supply of sort of European safe fixed income has just collapsed. Some of that's due to changes in ratings because of the lack of perceived, backing from the ECB. But also on top of that, overall debt in Europe has gone down a lot relative to both in absolute terms and I think and relative to the EU economy. And so, that creates a lot of weird issues. That's why you've seen such huge amounts of buying of, US fixed income from Europe as well. That creates various issues but instead of buying bonds that don't yield very much, you could be buying more goods and services, and then you'd be living better. So, there's a it's definitely, there's definitely, I mean, it is interesting. I agree to see the ECB's evolution on this, and how the response actually so far, I think, to the coronavirus is encouraging from the perspective that we take in the book of what could be better for Europeans.
Yeah. Since we're still in Europe, I'd like to jump to the audience questions. There's a question on Europe. I'll just read it to you. It says, regarding intra-eurozone imbalances, to what extent can they be kept in check by demand policy in surplus countries? And to what extent is institutional reform needed?
That's an interesting question. I mean, I think in some ways those are complementary. So, in Germany before the Euro crisis, so you sort of divide this into two periods. But before the Euro crisis, the big issue wasn't really. I mean, there was, arguably could have been different demand policy in Germany in terms of fiscal policy, but a lot of it was this sort of conscious decision on the part of businesses to boost their profitability at the expense of workers, and just essentially, keeping wages flat to falling, shedding workers, and then retaining more and more earnings. And that was not a political choice, right? That was a sort of choice of businesses as a whole, and you could argue that it was sort of individually rational, but that was then ratified by the rhetoric and the policy decisions that were made in the early 2000s. And you could change those things. So would it be demand policy to sort of? I mean, I'm not saying that undoing Hartz IV is the answer, but to the extent that precarity of German workers has gone up a great deal, reversing that, or for that matter, increasing the confidence that German retirees or soon-to-be retirees have in their future living standards, that seems to me like a sort of structural policy, but it would also be something that would have sort of sustained impact. And you can imagine things like that in a lot of different countries, depending on their specific circumstances.
Mm-hmm. The rest of the questions will be slightly jumping from here to there, so we'll just take a roller coaster ride. And we'll go back to the US. The question is, so through the lens of your perspective, your model, should the US so the question is, I'll rephrase the question. The question is, I think, for the US, would working classes benefit from a tax on capital flows? I think there was this huge discussion on capital flows on Twitter a couple of weeks ago. So I think we should take this up. What's your point on that?
So, we talk about this a little bit in the book, and essentially, if the underlying problem is that globally there isn't enough demand relative to productive capacity, then as an individual country, you essentially have two choices. One is you can just try to raise your own domestic demand, but the knowledge that some of that's going to leak abroad and some of that's going to be retained for your own workers. And then the other thing you can do is essentially just sort of redirect the problem of insufficient demand to someone else and essentially try to grab more market share for your own workers. The second option is perhaps more realistic, but also less constructive. The first option is one that might be good for the world as a whole, but also if you're the only one doing it, it's not. There are a lot of costs to that as well. So there's sort of like a collective action problem. And we talk about both essentially in the U.S. context. I mean, the capital flow management measure, which is the IMF term, would be essentially the second category. It's essentially saying, well, we're going to try to grab for ourselves, or at least prevent the rest of the world from sort of unduly dumping. And so. Yeah, I mean, that could definitely help. I mean, the way it would work presumably is you have a lower exchange rate. This goes back to the exorbitant burden argument, and that would lead to more domestic production satisfying domestic needs compared to imports, which could be bad for people in the rest of the world. And it's going to lead to more of your exports doing well, taking market share from producers in the rest of the world. So good for you, bad for someone else. That is a zero-sum outcome. Might be, but not saying it's necessarily the worst possible choice, but that's sort of the way of thinking about it, I think.
So do I understand correctly that imposing a tax on capital flows in the US unilaterally would cause problems for working classes elsewhere?
Well, there is one, argument, and this is something we bring up in the conclusion, because we don't spend a lot of time on the specific question, but insofar as the US has been one of the main outlets for the rest of the world's imbalances. Essentially, like if you have societies that systematically produce a lot but don't consume it because of various reasons, whether it's Germany or China or elsewhere, the way they make that work is they have to sell that excess to somebody, and it disproportionately tends to be the U.S. And the reason it's painful for the U.S. is because it generally comes to the extent. So if the U.S. made it so that was no longer an option, whether it's through financial controls or trade limits or whatever, then you can imagine that forcing some kinds of political changes in those countries that are the source of those gluts that could potentially lead to higher domestic demand there, and then ultimately actually would make everyone better off. So, but I mean, there's like a couple of steps there. Mm-hmm. You don't know if it would work that way, but it's plausible. If this goes back to sort of the very original argument of our book, or sort of underlying argument of the book, which comes from a British critic of imperialism from the late 19th century, early 20th century, John Hobson, and he basically said the reason why you have this push for colonies and imperialism was because the capitalists in England and France and Germany, and Belgium, didn't want to cede purchasing power and income to their local working classes, but they wanted to maintain their profits and they wanted to keep people employed. So the only way to make that, to fit all those parameters together is if you're selling a lot to other people who don't really have a choice. If you didn't have that outlet in the imperial colonies, then you presumably have to have some kind of domestic changes. And so the sort of constructive interpretation of what U.S. limits on foreign imports or foreign capital flows would do is that it would compel, or at least strongly encourage, useful domestic changes in other societies.
Would you say the same argument holds for the eurozone? I mean, since we're here, because the
eurozone is a surplus area. So they're one of the places that arguably needs to make changes, right? I mean, there are several structural issues in the way the euro area works, both just sort of like a technical level, which a lot of people talk about, like, well, it's too bad that the countries that generally have the most need for stimulating domestic demand have the least fiscal capacity, that kind of thing, and like the limits of borrowing and stuff. But then there's also these other issues which you talk about that sort of predate that, in terms of Germany specifically, and then how that sort of spread those specific policies, like the rise of precarity and weakened worker protections that goes from Germany elsewhere. Those are other problems. So I think it kind of goes both ways. That I wouldn't say that I can imagine European. I mean, the fact that Europeans are now reacting to the coronavirus by saying we want to devalue the euro, given current conditions, I think is sort of endemic of this idea that foreign demand is going to be more important than domestic demand, which, given the state of the European economy and the systematic underinvestment, underconsumption for a very, very long time, like that seems like the wrong response to me.
Yeah. There's a question on central banks. What's the role of central banks in trade war is class war? In mainstream economics, central banks just smooth the business cycle, but don't permanently shape trade or class. Your book,
that's a good question. I mean, I think there's an extent to which you can say that if central banks have sort of systematically different preferences about how they smooth the business cycle, that could lead to differences. So, for example, if you could say to a degree that, like, if the Fed were more responsive to domestic demand shortfalls than the ECB, which you could say was probably right in the period of like 2000 to 2011 ish, that could lead to trade differences. But I don't know. I mean, like, I don't really think that's the main driver, to be honest. I mean, like, we talk about like how central banks, some of the things they do, and swap lines, for example, like there's an interesting element there. Like, if it's easier for people to access dollars in emergencies, maybe they don't need to accumulate as many dollars before there's an emergency, and that can lead to things. But that's not.
I guess the swap line argument would be much more of one where central banks are a backstop to global elites, right?
Could be. I mean, it depends. So, like, I think there is a legitimate argument for precautionary saving by some emerging markets. Or I can understand why it happens. Basically, you look at the reaction to the Asian financial crisis and the response to that. I mean, if we're backing up a little bit, like, what's the point of the IMF? The point of the IMF was that if for whatever reason a country loses access to foreign financial markets and suddenly can't import things that it needs to import, the IMF will step in and provide the financing to make it, at least help them adjust. Like, it hasn't really done a very good job of that, I think, ever. Certainly not, the past 20 plus years, but I think even before, you can look at advice was for a different kind of crisis and just ended up making things worse. I mean, you can understand why Korea, which I mentioned earlier, like, they pretty consistently had trade and current account deficits from independence until then. And then basically ever since, we're saying, nope, we're never going to have that happen again, no matter what. And so you have this quite persistent shift in behavior in Korea, and then countries that also watched what happened in Korea. I think, by the way, you can make an analogy to the euro crisis too, that like the change in fiscal policy, even above and beyond what's required by the fiscal compact and Maastricht and all this stuff in a lot of the crisis countries, I think is attributable to the fact that, like, nope, that was enough. We're never going to do that again. I mean, there's some stuff, really interesting stuff written actually about Hungary, which is not in the euro area, but like they had to get an IMF bailout because of what happened 2008, 2009. And you can look at this massive, massive shift in a Hungarian fiscal policy and a financial regulatory policy and in the current account and the trade balance in Hungary. And basically you can interpret that as saying, like, we are going to endure a tremendous amount of, persistent, pain living below our means to prevent the possibility of an extreme unexpected event. And so if that's the scenario, you can understand, like, it's natural as a corollary to that's going to lead to underspending and exacerbate these problems we talk about in the book. And I think, like, I can understand that. I think the solution to that isn't just to, like, say, forget about it, it's not a problem. I think the solution to that is partly to address the legitimate concern that, governments might have about this risk. And I think one way you could do that, it's not the only way, but like, if you're worried about suddenly losing access to these things, if this is something that Adam Tooze made in his book Crash, I think pretty convincingly. Like the ECB did not do a good job of providing access to euros to, for example, the Hungarian central bank during the crisis. And like if that had been different, maybe there would be a different reaction. The Fed has become progressively better about making it easier to get dollars, but again, it's not like a consistent thing. So I think that at least to the extent that these kinds of precautionary efforts affect demand for dollars, it's not the only factor by any means, but it's a factor. Like you can have different central bank policies that would hopefully reduce that.
I just actually, so I mean, this is just a side note, but I just read there's a blog post by Isabel Schnabel and Fabio Panetta from the ECB board where they explain the reasoning to give swap lines to other to euro swap lines to partnering countries. And the reason they give is to support the international role of the euro, which specifically speaks to they actually change the structural position of countries' your assets, I guess. Mm-hmm. There's another question that I would like to pick up. It's asking, isn't a huge part of your book's thesis basically Marx Capital plus a theory of imperialism and underconsumption? And it is striking. I feel like I think you never mention Marx anywhere.
That's right.
Yeah. How come?
Well, I can tell you because we actually did get one of the long criticisms we got in a series of blog posts was actually from a Marxist economist saying that we are not Marxists, that we are Hobsonians, which I think is consistent. So yeah, I mean, that's one reason. But I think, I mean, I'm not going to act like I am an expert on Marxist economic theory, but my understanding is that a key part of it is that the reason that you have these problems is the declining rate of profit, and that leads to lower investment. And that's not really the argument that we're making at all. That actually, I mean, in some places, lower investment affects, it contributes to the reduction in, overall demand. But in general, we're making, the Hobsonian point of it's underconsumption. And even underconsumption is an argument that predates Hobson. I mean, he's the one who really kind of brought it to the fore in explaining international trade disputes, which is why it's so, I mean, this is 120 years ago at this point, but it's still basically the same argument. So, we put that right in the front. But yeah, I mean, I think it's a little different than the Marxist point. And also, this is not another crucial difference, and particularly a crucial difference between Hobson's version and Lenin's version, because Lenin's argument of imperialism was based on Hobson. But the key difference there is that Lenin said this was inevitable. It was an inherent consequence of the capitalist system, and it was doomed to end in war and revolution. And Hobson did not say that, and we don't say that because I don't think that's right. I think that the history shows pretty clearly that this is I'm not going to say it's a technical problem, but it is a problem that doesn't require breaking the entire system. That there are relatively straightforward ways of fixing this. I mean, it's a political problem, but it doesn't require a revolution. I mean, we know what caused these things to happen, and we can presumably just do different things.
It's an interesting. I like your trust in agency and the abilities we have to choose freely politically. Maybe this goes in the next in the same direction. So after the pandemic, there will be still large balance of payments problems or imbalances. China will push supply. The U.S. may be gridlocked until election or a long time after. The EU is a basket case. So where would growth come from in that scenario?
That's an interesting question. I mean, something I've been writing about in my day job at Barron's a lot, and just had a piece come out a couple of days ago on this, and basically every month tracking this is the extent to which the pandemic, in many ways, has sort of exacerbated these imbalances. That if you look in particular, the recoveries, the nature of the recoveries in Europe, U.S., and China, they've all been very uneven, and they've been very uneven in different ways from each other in kind of interesting ways. So in China, industrial production and real estate investment have been the predominant drivers. Consumption has lagged. Whereas in the U.S. and Europe, it's really been goods consumption that's been driving things, and manufacturing production and other things have lagged. And that's understandable. That's a big shift in trade. So the U.S. trade deficit has widened pretty dramatically, particularly on the manufacturing side. China's trade surplus is basically hitting all-time highs. Some of that's also due to things like decline in tourism and so forth, and commodity prices. But still, even just on the manufactured goods side, China's trade surplus is hitting all-time highs. So yeah, it's making it worse. I mean, I think that, to your point about agency, like, it doesn't have to be this way. Like, if the pandemic is over, I mean, part of it's like the pandemic itself affects a lot of these behaviors, and then it's also like the political economy in China just makes it a lot easier for them to stimulate production than it does, and fixed asset investment more so than it does household consumption. Part of it.
I mean, it seems to me rather that, as you're saying, the pandemic entrenches these imbalances, and I don't really see how it, would change afterwards, unless maybe the EU becomes a major spender and Germany starts seriously, abolishing the debt brake.
I think Europe's is really, I agree. I think Europe's the interesting sort of wild card here, because that could be, the other wild card is that the U.S. in a negative direction, which is that, the extent that the fiscal support in the U.S. was initially very strong and now is basically completely turned off. If it doesn't turn back on again relatively soon, then we could see, I think, a very unfortunate reversal in, things. And that would be an example of a situation where essentially the consumer side falters much more than everything else, and then who knows how that would play out. But I mean, that would not be a positive outcome. Yeah. I think, as you said, though, Europe, I think, is a really interesting case. Initially, anyway, you did see, if you look at sort of retail sales excluding food and fuel in Europe, it ended up surpassing the pre-pandemic levels because, for similar reasons, I think, is what you saw in the US, which is you give people a lot of money and they can't spend it on a lot of services, and they were like temporarily not able to buy certain things they wanted to. You're going to you see that spike. Now it's since turned down a little bit, which is concerning. But I mean, I don't know. That's it's a big open question. I mean, I think, I don't. If I knew that, I could at least like work in Crete. I don't know. Sorry.
I'll take one more question, and then I guess we'll give it a. I mean, it's not evening for you because you're in San Francisco, but it's evening here. Oh wow! Questions just shifted around. I'll take the one that's next. So somebody's surprised to see that Netherlands has such a huge household and private sector debt, but is running such a high surplus. Why?
So that's a good question. Netherlands is not a country we spent a lot of time talking about in the book. I have looked at it before once in my, back when I was at the FT years ago, and I'm not going to pretend to be an expert here, but the household debt, the business debt in the Netherlands, I think, is a function of tax structuring. That's also true for Belgium. So I don't know how seriously I take the business debt aspect of the Netherlands. The household debt aspect is a mix of things. And one is that housing is very expensive, and the other thing is that there's sort of weird tax advantages to doing that. And if you tell Dutch people, you say, "Oh man, household debt in the Netherlands is really bad," they say, "Oh, it's fine because when you basically it's all we have like liquid pension stuff that backs it, so it's not really debt." Now that having been said, the high debt in the Netherlands went down, and that did lead. I mean, you can very clearly see in the data. Like one of the reasons why, for example, the Netherlands did actually pretty badly during that sort of period. It wasn't a euro crisis country by any means, and yet, employment fell, consumption fell, a lot of things. It looked, it was not good. I think you can attribute to that.
Yeah.
But I mean, I guess the other thing is that like domestic debt and current account balance, it really depends on sort of a mix of factors, right? Like the U.S. in the 1920s also had a huge housing debt bubble, also had a massive current account surplus. Japan in the 1980s, China for that matter, right? Like Chinese debt expanded basically by the most ever as a share of GDP between like 2008 and 2013, and the current account surplus did shrink during that period, but didn't disappear. So, there are a lot of countervailing forces at work, and I think what exactly is driving what can be tricky to, you have to do a very comprehensive analysis of the Netherlands to really thoroughly answer that question, and I've not done that.
Yeah, that's fair. Well, thank you so much. It's been a very enlightening evening for me.
Thank you for having
me. There's one last question that I'm going to put to you because we've put it to every other guest. Is there anything that you're reading right now, or that you read in the past couple of months that you would really, really like to recommend?
That's a good question. I read a book while I was on parental leave that I liked a lot called Escape from Rome by Walter Scheidel, who's a professor, a classicist at Stanford. And it's a very interesting book about basically the rise and fall of the Roman Empire and why you didn't really see anything like that happen again in Europe, and what the implications were for Europe, and why Europe ended up sort of dominating the past few hundred years of human history when other parts of the world did not.
Perfect.
It's a very interesting, provocative book.
All right. Thank you so much. For everybody listening, thanks for listening. Thanks for the amazing questions on sli.do. That was, we didn't get through all of them. I mean, Matt, I don't know, you're probably not going to go through them, but maybe we'll just get a second round of this. It was a great discussion. Thank you so much.
Great. Thank you for having me.